Most traders think the market explodes out of nowhere, like volatility just appears without warning. But institutions never move without building the perfect environment first. They don't rush. They don't chase. They don't feel FOMO. They design the conditions they need, and the number one condition they rely on is controlled risk, engineered chaos wrapped in a calm, quiet shell. The kind of calm that makes retail traders drop their guard, misread the structure, and walk straight into the liquidity trap. Because before a storm hits the chart, a stillness always settles in, and that stillness is not coincidence. It's strategy. When institutions want to move large positions, they can't just click buy or sell. Their orders are too massive. If they enter too fast, they push price against themselves. So what do? They engineer a zone, an area where price sits still long enough to attract retail traders on both sides. They let the market create the illusion of safety, a range that feels neutral, harmless, and predictable. Retail looks at it and thinks, nothing's happening. Let me scalp something small. But that range is a container. Every candle inside it is collecting liquidity for the institutional execution that's coming next. Retail traders think consolidation is boring, but for institutions, a quiet market is a buffet table of free liquidity. Every premature breakout attempt, every scalp, every stop loss placed too tight, every retest that fails, these aren't mistakes. They are contributions. They are deposits. They are the fuel institutions need to fill their positions without causing slippage. Institutions wait patiently as retail traders unknowingly provide exactly what they need: emotionally driven orders scattered across predictable areas. And when enough orders accumulate, something interesting happens. The chart starts moving in small spikes, tiny manipulative wicks grabbing both sides of the range. Not enough to break structure, just enough to trigger emotions. Fear on one side, greed on the other. Retail traders start thinking the breakout is coming. They enter too early. They get stopped out. They re-enter. They get trapped again. And while this sequence plays out, institutions slowly fill or distribute their positions. They don't care about the noise. They designed it. The calm before the storm is not silence. It's extraction. It's harvesting hidden orders sitting quietly in the liquidity pockets, stop losses, limit orders, emotional entries, and panic exits. And the moment the liquidity pool reaches a critical level, the market erupts. Volatility isn't chaos. It's the release of pressure institutions have been building. The storm you see is not market randomness. It's planned acceleration, a controlled detonation that happens only when the liquidity required for the move has been secured. This is why huge breakouts often occur right after retail traders give up. When they stop expecting the move, institutions get the cleanest environment to trigger it. Because when retail loses patience, institutions gain control. Most traders don't realize volatility is just a signal that the loading process is complete. Think about every time you've watched the market fake a breakout, fall back into the range, fake the opposite direction, trap both sides, and then explode with full force. None of that is random. That's engineered chaos. Institutions use patience as a weapon. Their patience creates emotional fatigue in retail traders. You look at the same levels over and over. Nothing changes. You get irritated. You take a risky trade just to feel active, and the moment you place that emotional trade, the cycle captures you. Institutions aren't trying to beat you. They're trying to exhaust you. A tired trader is predictable. A bored trader is impulsive. An impulsive trader provides liquidity, and liquidity is the oxygen institutions breathe. You've probably heard traders say, the market respects patience, but the truth is deeper. The market rewards the trader who understands that stillness is not inactivity, it's information. The quiet zones tell you institutions are present. They tell you accumulation or distribution is happening. They tell you the market is not dead, it's charging. And the longer the consolidation lasts, the more violent the expansion afterwards. Think about the weekly and daily timeframes. Before every major trend shift, bull runs, bear collapses, massive reversals, there's always a compression phase. Price tightens, volatility drops, indicators flatten, retail stops watching. Institutions accumulate silently, and one day, without warning, the storm hits. Everyone else is scrambling. But for institutions, it's just execution. The work was done weeks earlier during the calm. Institutional patience is not passive. It's aggressive in disguise. It's waiting for retail to expose their vulnerabilities. It's letting fear and hope do the heavy lifting. When traders think, okay, this is definitely the move, institutions take the opposite side. When traders think, this market is dead, institutions know the perfect moment is close. They thrive on the imbalance between what people feel and what the market is actually preparing. And this is where retail traders lose, not because of lack of skill, but because of misreading silence. They crave movement. They want action. But markets don't reward action. They reward precision. The game is not about constantly trading. The game is about understanding when not to trade. The calm phase is not your enemy. It's the only time the chart tells the truth. The storm is loud, chaotic, confusing, but the calm is transparent if you know how to read it. When a range forms and price keeps grabbing both sides without commitment, that's a sign institutions are loading. When volatility compresses and candles get small, that's a sign the market is preparing. When wicks start appearing at key zones repeatedly, that's a sign liquidity is being tested. When you feel impatient and start doubting your own system, that's a sign the market is controlling your emotions. And when emotions are controlled, liquidity is controlled. To trade like a professional, you must stop thinking like someone who needs the market to move. You must start thinking like someone who understands that waiting is a phase of strategy. The waiting is not wasted time. It's the part where your competition destroys itself. Most traders lose because they trade during the calm. Professionals win because they prepare during the calm. The storm is where both traders show their results, but the outcome is already decided long before the volatility starts. Controlled risk is not about minimizing losses. It's about minimizing emotional exposure. If you're impatient, you're exposed. If you're bored, you're exposed. If you're trying to force the market to give you a setup, you're exposed. Institutional patience is the art of letting the market reveal the next path without forcing your own interpretation on it. Because the moment you try to push your expectations onto price, you walk into the engineered chaos that was designed to exploit exactly that mindset. Institutions don't rush because they don't need to. They have capital, time, data, and algorithms. But retail traders rush because they feel pressure, financial pressure, emotional pressure, psychological pressure. And pressure forces bad decisions. The calm zones are the real battleground, not the storm. The storm is just the conclusion. The accumulation zones are where the victory is constructed. If you learn to read those zones, you stop reacting and start anticipating. You stop being liquidity and start trading with it. The market is not moved by price. It's moved by liquidity. And liquidity is moved by emotions. Institutions don't look at your strategy, your indicators, or your analysis. They only care about where your fear will make you place your stop losses, where your greed will make you chase entries, and where your impatience will make you take low-quality trades. They map your behavior, they wait for it, and then they exploit it with engineered calm followed by violent expansion. Once you understand this cycle, your trading transforms. You stop trading the noise. You start trading the structure. You stop getting trapped. You start predicting traps. You stop fearing volatility. You start recognizing it as the release of institutional preparation. And most importantly, you develop patience. Not because it's virtuous, but because you finally understand why it's profitable. If this breakdown gave you a deeper understanding of institutional behavior, hit that like button so more traders can see this truth. Comment and tell me which part opened your eyes the most. And if you want more clarity, more psychological depth, and more real market insights, then subscribe right now and turn on notifications so you never miss the next episode.